Hi there, I'm Christian Reither of Curreen Capital, and today I want to talk about the inverted yield curve and what you can do about it. If you're like me, you've seen a lot of articles and maybe videos about the inverted yield curve over the past few months, and what I've noticed is a lot of them seem to get bogged down in what it all means and what caused it, and I don't think that we want to do that. I think we want to keep moving and try to figure out what to do about it. And I think we can do that for two reasons. First off, investing is always about investing under uncertainty. You don't know what the future is going to be, you just have to make smart decisions anyway. And second, once you start talking about money, interest rates, and the global financial system, you go through this looking glass world into Alice in Wonderland, and people lose their minds and they just talk and talk and talk about their favorite economic theories, and it's all very interesting, but it doesn't get you to a decision, which is what we actually need. So let's try to keep it simple. Is an inverted yield curve good for the economy? And I think the answer is no. In a functioning economy, you want to incentivize people to be self-disciplined, to think about the future, and to sacrifice consumption today to produce something valuable in the future that benefits themselves and everyone else. You usually do this by paying them to lock up their money and to lock themselves into long-term stuff. That is reflected in a higher interest rate for long-term bonds and long-term investments than for short-term bonds. But that's not what we see now. Right now, the 3-month Treasury rate is higher than the 10-month Treasury bond. What is that? It's like the opposite of the marshmallow test, where the kid who eats their marshmallow immediately, you give them more marshmallows, and the kid who's self-disciplined and, can't see the marshmallow, you're like, you suck. We've got too many of you. Everybody's patient these days. What we want is impatient people who can't sit still. It's a weird thing, and it's not how a functioning economy works. But that's where we are. So we've got this weird thing. What market is it affecting? It's affecting the U.S. Treasury market, which is perhaps the most important financial market on Earth. CAPM says that this is where you get the risk-free rate that is used to price every single asset on Earth. Regardless of whether you like CAPM, it is one of the most liquid and most largest invested assets on the planet. So we've got one of the largest and most important asset classes on Earth being distorted in some weird way. Whatever is causing this is a very powerful force, and it's doing something weird. This is where people get lost and they start talking about what it all means. Let's not do that. We just know that it's weird and it's very big. So what can we look at? How have things performed after the Treasury market has been inverted in the past? Well, for that we need to define our terms. The way I look at it is interest rates over a month, so monthly averages. So first for 3-month Treasury in the secondary market, and second for 10-year Treasuries, constant maturity, because those get issued less frequently. We have good data on that from Fred going back to 1953. We have six periods of inversions, starting with September 1966, January 1969, June 1973, December 1978, August 2000, August 2006, and now we have June 2019. These have tended to be followed by bad periods for the economy and for the stock market. We can also look back further if we want confirmation of this. The last time before 1953 that we had an inverted yield curve, we had one in 1928. It might have started in 1927 or 1926. I don't have good enough data to tell you, but that was before the 1929 crash and depression. We also had an inverted yield curve in 1919 before the 1920 depression. We had an inverted yield curve in 1913 before the World War and stock market decline. So even where we don't have great data, we have signals that the inverted yield curve is not a good thing. But we do have good data on these 6 past events. What does it tell us? Well, on recessions, which everybody seems to care about with the inverted yield curve, 5 out of those 6 periods were followed by recessions, according to NBER, within 18 months. So there was no recession within 18 months after 1966. The other 5 events, yes, there was a recession within 18 months. That's bad, but we're stock market investors. We care about markets, not about, we don't bet on recessions. So how did the stock market perform? In 4 out of those 6 periods, you had a 30% drop in the S&P within 2.5 years. So 1966 was not followed by a 30% bear market within 2.5 years, nor was 1978. The other 4 times were followed by these very bad bear markets. I want to say that the yield curve was not the top in any case except for 2000. After 1966, obviously the market kept going up. After 1969, the market was already in a bear market before the inversion. Same with 1973. 1978, there was no bear market, or you were just in this crappy market forever. 2000 marked the top. 2006, you had another 20% rise in the S&P 500, and it kept going up for another year. So it's not necessarily the top. It may be before, it may be after, even if there is a bear market. So it's not telling you, get out now. And it is normal, 5 out of 6 cases, it is normal for the stock market to keep going up for 3 months after the yield curve inverts. So if people are making fun of it now and ignoring it now, that is entirely consistent with history. So let's recap. We've got a weird distortion in the economy. We've got it affecting one of the most important asset classes on Earth, the U.S. Treasury market, and historically speaking, it has demonstrated a higher probability of both recession and bear market afterward. That's where we are. What do we do about it? Do we just sell our stocks because there's this higher risk of recession and bear market? There's no price based into the inverted yield curve. It's just based on, it doesn't care what the stock market price is, and sometimes the stock market is cheap. So we don't want to go crazy, but let's think about it. And I think the first thing to do is, if you're investing in individual stocks, which is what I do, keep doing what you're doing. You don't want to not seize a good opportunity and not make a good investment just because you're worried about the future, just because historically speaking this has been not a good time. There will be good investments that you can make before any bear market. And if you find one, you should seize it. What you should do is incorporate a much higher than normal risk of a recession into your valuation. So for me, my downsides all have a pretty bad recession in them, and my reasonable case doesn't look that good for the next 2-3 years. But if you do that and you still find something that's cheap, go for it. The other thing you want to do is be careful about using relative valuations, because if there is a bear market, and if we have this higher risk of a bear market, those relative valuations will come down, and if you're getting a discount to this, you might be paying too much for this. So that's how I would think about this if you're picking individual stocks. If you're investing through someone else, through a mutual fund or whatever, you might want to think about selling. Or you might want to stay the course, keep your diversified portfolio, don't act from emotion, or do any of the things that the big mutual funds are telling everybody to do. That is self-interested on their part, but it's not terrible advice. If you sell now in a taxable account, you will definitely pay taxes, and we don't know if this is going to lead to a bear market. 4 out of 6 times in the past means it happened in the past. We don't really know what is going to come in the future. I think 66-67% chance is enough for me to wear an umbrella if that's what my weather app tells me. It's not great, but there are real costs to selling. First, there's the taxes in any taxable account. And second, you then have to come back into the stock market. You have to make a smart decision in selling and a smart decision in buying. And a lot of people who got out, say in 2009, stayed out way too long. And it's not like if you hide in a tornado shelter and you come out when the coast is clear. With the stock market, you come out when everything looks terrible. You want to come out when stock prices have been going down forever because people think it's going to keep getting worse. Everything you read, everything you see is all about how people have made money in these crazy weird asset classes. And stocks suck, are stocks dead, that kind of thing. It's hard to make that decision. If you made it in 2009, you're qualified to make it again. Otherwise, that's a hard decision to make, and it might be easier just to stay the course, focus on your normal life and your normal job, and not focus too much on the stock market, and just take the pain, because we will have pain in our lives, and it's not necessary to always run from it. But if you do decide to sell, and I think There's a decent case to be made to sell something. I would try to focus on selling expensive things. S&P 500 I think is expensive. I think there are expensive stocks in there that aren't growing very much. There are also stocks in there that are priced on like 20, 30 earnings or something like that. And like it's a little too patient, a little too optimistic. Sell those things. I wouldn't go ahead and just get out of everything cyclical because some of those have already gotten very cheap. Maybe they're too cheap, maybe not. But I'd focus on the slow growing or super expensive stuff. Where do you keep your money if you do sell something? Money market, treasury money market, I think is your default. After an inversion, you might see some sort of financial stress in the market. I wouldn't want to be worried too much about the bank that I had bought my CD from. I wouldn't want to be worried if my money market fund was invested in Lehman or something like that. I would want a treasury money market fund or just to buy treasuries from Treasury Direct. That's a safe way to do it. You can probably do that. Then your main challenge is keep your head, come back in when things are cheaper. You won't nail the bottom any more than you're going to nail the top if you sell now. But it is something that is doable. So it has that to recommend it to itself. What else could you do? You could sell stocks now. You could short. You could buy puts. I would avoid shorting and I would avoid buying puts on the S&P 500. When I looked at puts, you can get puts out to December 2021. Soon you'll probably be able to get them out to December 2022. I didn't like the upside downside. Looked like I could lose everything if I was wrong, or if it took too long. Maybe the Fed, is pumping all this money in, and that is going to forestall any problems. And I don't want to have my put expire before, the great reckoning comes, if there is such a thing. Second, I would lose all my money if I was wrong or if it was too slow. And if it worked out, I would make 2 or 3 times my money. That's not a great upside downside for me. And if I was buying at the current price, the market would have to drop 10% for me even to be to make my money back. Puts, not a great investment. Shorting, if you're good at it and you've demonstrated that in the past, go for it. If you are just learning now, why? Just don't. Professionals who are good at shorting have lost a lot of money in the past when the market was inverted, right before a bear market. You can look at Juliet Robertson and the Tiger Fund if you want an example. Very smart guy, knew what he was doing in shorting, did not help. I don't want to be right about there being a much higher than normal chance of bad things and still lose. I don't recommend shorting any more than I do puts. What else could you do? You could buy long-term treasury bonds. Stanley Druckenmiller said that's how you make your money in a crisis, not by shorting. You buy these long-term treasury bonds. It's certainly been working in 2019. The data doesn't support it. So out of those 6 events where we had inverted yield curves, 4 of them in the past did not work out for long-term bonds. Interest rates kept going up until Volcker killed, the bond bear market in 1980. So all the inversions before 1980 did not work well for long-term bonds. They've worked in 2000, 2006, and so far in 2019, but the data doesn't support buying long-term bonds. If you want to hide out there, you're making a bet that is not supported by data, good luck to you. What other options? You could buy Bitcoin, but there you have 0 data because Bitcoin prices started in 2010, so we have no data from prior inversions. I don't want to mess with no data from prior inversions when I have a very good opportunity to buy treasury bonds, treasury bills rather. So I would stick with the simple there. Is there anything else that you could do other than treasury bill money market account? Surprisingly, gold has been a good option. The barbarous relic has worked out in and after prior inversions. Now I'm talking about post-1975 when it was legal for U.S. investors to own gold. So we don't get to see 66, 69, or 73, even though there was a London gold price prior to that. I think it was based off of whether Nixon would break the gold standard and whether United States investors would be allowed to invest. Plus, by the time 75 rolled around, whatever, you don't have a good data set on those 3. It's not as clear. But in the 3 events since then, 78, 2000, 2006, and so far, frankly, in 2019, gold has outperformed treasury bills. So you've been better off in gold than you would have been in a money market account in those 3, maybe 4 data points. Not a great data set, not high, but I think that does make theoretical sense. People tend to buy gold when they're worried about bad times, which heightened risk of recession and bear market would tend to drive people into gold. The central bank response to recessions and bear markets is to pump money into the system to lower short-term interest rates. That lowers the opportunity cost for owning gold, and it makes people start thinking about, oh, all this money printing, and again, this drives people into gold. So it makes theoretical sense why gold would work, and you have some statistical data showing that it has worked. So if you want an alternative to cash, if you've sold some stock because you're worried about an inverted yield curve, gold actually is not a terrible idea. There are some caveats. Gold will not peak when stocks drop, so again, you have to make a smart decision to buy stocks, and now you have to make a smart decision when to sell gold. You're not going to hit the peak in gold any more than you're going to hit the bottom in stocks, so you've got to make a lot more smart decisions. Also, the price of gold moves a lot, and the price of a money market fund does not, so you've got to keep your wits about you and not lose your mind watching the gold price every day, because it can drive you crazy. So, inverted yield curve is a big deal. Historically speaking, it has led to bad times for both the economy and for the stock market. You don't want to lose your mind. Staying the course is a solid option, but if you are going to sell, try to avoid paying taxes, try to avoid selling things that are already cheap, and move your money into Treasury bill money market fund, possibly into gold. I think that's what we can say looking at all this without having to resort to weird theories about the economy and trying to understand everything. Thanks for listening, everybody. Good luck out there. It might be bad. At least we can say that risks are elevated right now and caution is in order. But forewarned is forearmed, and now you are both. Best of luck. Bye-bye.